In January, the Federal Insurance Office, FIO, released data revealing that home insurance rates outpaced inflation by 8.7% nationwide from 2018 to 2022, due in large part to higher climate impacts. The data set reveals that insurer-initiated non-renewals, sort of retreat, above 10 or even 15% were quite common in zip codes scattered across the country, especially in climate vulnerable hotspots, but rates are rising almost everywhere. In many states and regions, insurer withdrawals and year-over-year doubling premium increases, for example, have resulted in millions of families losing access entirely or being unable to afford adequate coverage. The insurance protection gap is growing at an alarming pace. Though small insurers are more susceptible to failure due to their concentrated risk, we have also seen insurers take advantage of the climate framing to mislead their policyholders and the public. A 2022 report found that insurers in Florida paid their shareholders $680 million in dividends and diverted billions to affiliates, while telling their policyholders and the public that the back-to-back hurricanes Irma and Michael were causing insurers to lose money overall. This type of shell game is not uncommon in the insurance sector. Meanwhile, large insurers are asking for public bailouts, as we saw recently in California, where the Residual Market Consortium of private insurers asked for a special $500 million assessment on families throughout the state. While the insurance system tilts, the Trump administration has decided that now is a good time to attempt to dismantle already underfunded federal disaster preparedness and recovery programs under FEMA, to privatize climate data collection and research, firing hundreds of NOAA staff members, including climate scientists and weather forecasters, and to remove critical climate risk transparency and risk management rules for the financial sector. We know that some of these changes were explicit priorities for the oil and gas sector, who spent nearly $500 million on the 2024 election cycle, but it's worth asking, who else does stripping these protections help? Certainly not the public, who will need to pay even higher insurance premiums if federal disaster resources are pared back.
So just to lay the land a little bit, I'm in a rural county in where wildfire risk is high. What we've seen starting a couple of years ago is that our insurance agents, our insurance rates have doubled and tripled, and we've actually had all but one insurance company withdraw from writing policies in the county altogether. So about 3 years ago, we heard that our fire agency was losing its insurance, had 30 days to find a new insurer. They actually had to close down for 2 months before they could find another insurer. We have homes that are losing their insurance. We have elders on fixed incomes who have no choice, no way to bring in extra income to meet those rising rates or find a way to get on the FAIR plan. We have young people who are struggling to find housing in the first place, who no longer can find rentals because even they are going up because of the insurance costs. And our county has invested thousands, hundreds of thousands of dollars, along with millions of dollars coming from federal grants and working with our federal agencies to create shaded fuel breaks out in the forest to protect the cities that are behind them. So we're leaning into doing everything we can. So I've collected a number of county agencies from across the state, and we've come up with suggestions for what needs to happen to make this work better for us on the ground. The number one thing is that mitigation work that's being done by us, by counties, by federal funds needs to be reflected in the lowering of rates. So when we do all the work we're supposed to, we reduce the risk to the insurance companies by 40 to 60%. We need to see that reduction in risk return to us in a reduction of the rates. Again, people are being priced out of their homes, even if they're doing the work around their own homes. So we need to see that those rates reflect the mitigation that's being done. We need data transparency so we know what the insurance companies are thinking when they make their ratings. We need an appeals process. We need an agency like the FIO to be viable so they can find out what's really going on in the insurance agencies. And we need the federal funding that has been absolutely critical to maintain our work, the mitigation work that we're being told is effective. We need that funding to continue. In my own county, and I know this is reflected again across the state and across the country, we've had infrastructure funds stopped, paused. We've had The other Biden funds stopped. We've had BRIC funding stopped. And even when we were able on a one-by-one basis to get some of that funding returned, all the Forest Service staff who have to work with us to do all the regulatory um, uh, to jump through all the regulatory hoops, they have been laid off. So we are stopped dead in the water. Multiple projects that have been years in the making, which would make us fire safe, which would save lives in our communities, and would do the work to make it more affordable for insurance agents to come in and write policies. That work is stopped dead in the water.
I just want to start with some big picture framing around what we're seeing here, and one of the ways in which this crisis in the insurance market has accelerated so quickly. And one thing it points out more than anything else is how myopic the market has been about the growing risks of climate change. Because, of course, scientists have been telling us for decades that as heat trapping emissions rise, we will see these really sharp increases in extreme climate fuel disasters. And unfortunately, the market is still operating with a very short time horizon. And that's why the investments in climate resilience, really true resilience, not subsidizing risk, but actually making people more able to, and entire communities more able to deal with this challenge of climate change is critical. But we cannot adapt to runaway climate change. And that's why sharp cuts in heat trapping emissions are essential. So even as we're looking at this as an insurance crisis, let's remember it's colliding with a climate crisis, and it's also colliding with a housing affordability crisis in ways that are making it much worse for people with lowest incomes and who are on the front lines of these extreme risks. This is not just about homeowners. This is also about multifamily homes, affordable housing, where we're seeing landlords withdraw units from the market already. Survey data is showing that the cost of insurance is going to lead to even fewer affordable units being on the market. And we know that there's been a long-standing affordability crisis for lower income folks. Has deep equity implications as we go forward. In spite of the fact that these risks are growing, in spite of the fact that there's bipartisan support for efforts to reduce that risk, we're seeing major programs get withdrawn, like FEMA's BRIC program. The CDBG-DR program as well is one that has bipartisan support, is not permanently authorized despite there being longstanding support for it. And what we're finding is in this context, insurance companies that are withdrawing from the market for property are actually continuing to subsidize fossil fuel projects. They're continuing to subsidize the very thing that's burning down other places in the country. So there's a contradiction in the insurance market right now. We can't leave people high and dry on their own. That will only compound the misery and the harm. The math is not just for the profits of insurers and fossil fuel companies. The human aspect of this has to work for communities, for people who are on the front lines of this crisis.
The insurance crisis isn't the final or even the main chapter in the story of ways that climate change, which we know is driven by greenhouse gas emissions facilitated by the fossil fuel industry and enabled by banks and insurers, is financially devastating American families and quite possibly our financial system. In some ways, it's just the beginning of a death spiral for some regions of our country, as Dr. Cletus observed, but also families throughout the country. So insurers are taking the first hit, but our families and then lenders, municipalities, and the rest of our financial system are also feeling it, and increasingly so. Without insurance, we're seeing American families really struggling and failing to pay their mortgages and other bills. Household debt's growing, mortgage delinquencies are growing. Research from the Dallas Fed shows higher premiums significantly raise the probability of credit card delinquency and worsen borrowers' creditworthiness. As climate events hammer homes and insurers leave, American homes are losing their value. Currently, at least 20% of homes have lost real value in the US. It's the most important form of wealth for Americans. Powell says that because banks and insurers can leave and are leaving, they might be fine. State and local governments will end up paying the bill. This is what Jay Powell signaled during that testimony to the Senate back in February. That includes all of us as costs are spread, and they will be spread. As Supervisor Pyska observed, local governments can't handle these costs. Municipalities will continue to lose their tax revenue, struggle to make municipal bond payments as disasters multiply and insurers, lenders, and residents leave. Municipal credit rating downgrades have begun. Most recently, S&P downgraded the Los Angeles Department of Water and Power. They put several entities in North Carolina and Tennessee on credit watch. In the meantime, we know lenders are selling climate risky mortgages to Fannie and Freddie, government-sponsored enterprises, as well as investors heavily connected to other financial actors. What could go wrong? We have plenty of experts comparing this to 2008 already. I want to pause here for a second to make this next point. It's critically important. The former CEO and current board member of Allianz, one of the largest property reinsurers in the world, recently underscored that all of the capacities we take for granted in our financial system are limited, and we're fast exceeding them. Insurers are hitting limits. That's what we're seeing here. American families are hitting limits. That's what we're seeing here. Nearly half of Americans live paycheck to paycheck. Raising insurance rates to deal with this isn't going to fix this problem. Banks have limits, municipalities have limits, our government taxpayer backstop has limits. Ultimately, this is about our Earth's capacity, the limits in our Earth's capacity to assimilate greenhouse gas emissions. This means that many of the financial risks we're beginning to experience now aren't likely reversible. And this is a critically important point. Unlike previous financial risk, we can't just undo these. If we wait to see what's going to happen, we're here, it's happening. Reversing this will be incredibly difficult, if not mostly impossible. The Allianz rep says insurance withdrawals are a systemic risk that threaten the very foundation of the financial sector. He warns that at 3 degrees of warming, we'll have no more mortgages, no new real estate development, no long-term investment, no financial stability, one where the financial sector as we know it ceases to function. This is a major reinsurer that many insurance companies are relying on right now. He stresses there's only one path forward: prevent any further increase in atmospheric energy levels. That means keeping emissions out of the atmosphere. His statement, everything else is delay or distraction.
This one's for Heidi. How are Trump's plans to dismantle disaster preparedness and recovery resources going to affect your county?
Yeah, thanks for that question. There is no way to overstate how devastating these cuts are going to be, and frankly, already are. Lives are already at risk. Counties, cities, local jurisdictions depend on these funds to both be more prepared to do the mitigation effort to keep us safe, also for the recovery, which is critical to get people back in houses when they've lost their homes.
We had an audience question. How can we ensure that insurance companies accurately price climate risk without making insurance unaffordable for vulnerable communities? Aren't higher premiums an important warning signal in high-risk areas? You need to have the prices reflect the risk, but a lot of times following disasters, what happens is insurers use that as an opportunity to ask for a lot more rate. And we even see it be the case where they go above the actuarially sound rate because they're trying to make up for losses in a certain year. So what you saw in California after the Paradise fires was a bunch of years of amazing profitability for these companies that extended at least through 2022. You oftentimes see a sort of a jigsaw where there's a major disaster and then there's a lot of rate given out in a short amount of time.
I mean, there's increasing recognition that the cost and risk, which are rising, need to be shared with entities facilitating those costs and risks. So the fossil fuel industry, for example, banks and insurance companies underwriting, financing the fossil fuel industry. SB 222 in California was one such effort. We had an effort in Hawaii that was similar to that. You'll see more of that because, as we mentioned, there are limits that are being hit, and entities creating the risks need to start bearing more of the responsibility for them. So look for those proposals. Thanks.
Thanks, Anne. Over to Dr. Cletus.
Yeah, just to follow on what Anne said, what we're witnessing here is that fossil fuel companies and other fossil fuel interests have perpetuated a very, very large global challenge. And now individuals who happen to find themselves on the front lines of it are being told they have to pay for it. And this is an incredibly unfair and unjust situation to begin with. And this is why policymakers need to stop perpetuating this idea that these companies can operate unfettered and society will bear the costs, not just insurance costs, but public health costs and many other costs of these disasters. So yes, indeed, higher premiums in some cases are signaling higher risk areas. As we're all saying, there are ways to buy down that risk by investing in resilience, and we have to do that at a societal level, again, not leaving individual homeowners to deal with it. And then we have to recognize that insurance is not going to be a panacea. We will have to take broader measures, and that right now the lack of transparency in the insurance market is allowing companies to take advantage of these situations, to operate in ways that are frankly not in the public interest or even aligned with what people would call quote unquote free market. This is not a free market when you don't have access to the information and there's such information asymmetry. It's kind of laughable to call this any kind of a free market.
Yeah, I'll close this off by saying, people often respond to rising rates by foregoing insurance if they can, rather than moving. There's place a lot of value besides economic value on where they live. And and a lot of people don't have the resources to move anyway. So we're seeing a troubling drop of voluntary, buying into NFIP policies and home insurance policies, especially for folks who no longer have a mortgage. What would be, people just can't afford, people aren't able to afford the cost increases that are coming right now. And if they can't do that, just raising rates continuously will not be a holistic solution. So we need a whole bunch of actors coming together as we've discussed today.